Welcome back, and George Thomas from QuantumAMC is now joining in to talk more about the markets and his top sectoral ideas. George, good morning. Thank you for joining in. Before we get to sectors, I wanted to talk to you about IPOs. What are your rationales of investing in an IPO if you do? Because we're just highlighting a lot of these underperforming IPOs of last year, be it MobiKwik, be it Carraro. They've made new highs after listing, but since then they are down 50-60% from those levels. With the kind of IPO pipeline that is lying ahead of us, do you see a need to invest in an IPO with a FOMO sort of a mentality?
Hi, thanks for having me in the show. At Quantum, we generally stay away from IPOs, and that is for two fundamental reasons. One, generally, if you look at most of these IPOs, they generally come at the most opportune time. So if you look at the financials, the history, most of the cases, the IPO would happen at a cyclically high point where numbers look unsustainably high, and then most of the cases, the cycle turns once the IPO happens. And the second most important point is there is an idiosyncratic risk in IPOs where the seller knows much more than what the buyer knows. In many of these cases where there is an offer for sale, the most likely scenario is the seller or the promoter could be expecting some bit of cyclical downturn or some moderation in numbers. And in most of these cases, the seller would want to extract the maximum value for obvious reasons, and therefore most of them will not come at a fair valuation, or they may not leave much on the table for retail investors or the investors who come up on the IPO level to earn a reasonable returns from those levels.
Okay, right, George. That is something coming in on the IPO front, but let's shift focus and now talk about the markets. While we're seeing nothing much of an action happening, there's so much in terms of geopolitical tension that's still continuing. Earnings haven't been great, right, in Q4. It's not something wow or some sort of a recovery that we've seen so far. Then what should we watch out for from in terms of the Indian market? What is your outlook?
See, clearly the earnings were kind of muted for a few quarters now. So even in the March quarter, if you look at it, the revenue growth of BSE 500 on an aggregate level was just about 8%, but profit growth was slightly better. But our sense is, while the geopolitical scenario is quite difficult to predict, so if you look at the global setup with all these tariff-related news going on, the most likely scenario is the global growth may not be that great. And that is reflected across metals. If you look at any of the key commodities like copper, aluminium, steel, you are seeing an annual decline in those prices, which kind of gives you an indication that the global growth is not that great. And despite all the geopolitical or the Middle East tensions, the crude is still about 6% lower on an annual basis. So while inflation is moderating, the input prices are moderating. That gives some bit of margin expansion potential for Indian domestic companies. And from an India standpoint, we are seeing the inflation kind of moderating. And if crude remains at the levels which they are and the trajectory does not change materially, there is a very good possibility that the inflation scenario could be benign for the upcoming year. The inflation is benign, plus the monsoon has started on a strong note, and it's expected to gain steam from here. Plus, the base year is not a very high ask rate. So if you look at fiscal year 25, the growth, the base quarters were fairly high, so the base numbers. So that is not that. So that's not the case for fiscal year 26. So from here on, we are hopeful that there is room for margin expansion, and even demand could kind of start picking up. But our primary concern is on valuations, where valuations are not cheap for the broad markets. So even for the large cap universe, one might have to moderate their return expectations, maybe somewhere similar to low double digits kind of thing.
Sure. George, you're talking about monsoons also coming in, you're talking about inflation coming down as well. Then is consumption a story that you would look at? Staple consumption, is that something you watch out for? And where do you see value here?
See, we have a fairly decent allocation to consumer discretionary sectors through autos and then a consumer durable name. But the broader popular consumer staples, our sense is one, there are a lot of, the competition has inched up in that space. There are a lot more options for consumers than they had a few years back. And with all these digital channels and quick commerce coming up, the cost of supplying or establishing a brand may not be as tough as it was in the previous regime. And therefore, staples from a valuation perspective, it's still kind of elevated if we were to marry them with the kind of growth rates which they can clock over the next medium term or the next 4 or 5 years. So staples, we are not positive, but we are optimistic on the auto space, especially the two-wheeler space, where we feel there could be an improvement in consumption, and that could reflect in some of the auto volumes going forward. And we have a play through consumer durable company, which is kitchen appliances and some of the other consumer electrical category.
Would room AC manufacturers feature in that list of consumer durables as well, George? Because the commentary that we are hearing from a lot of these players is not the most positive. And this comes in a quarter that is traditionally supposed to be their strongest quarter, considering it is peak summer. And now that you are heading into what you can technically say an off-season because of the monsoons, the winters, you still retain that optimism despite the fact that this entire year could end up being a very challenging one for these companies.
So we have not seen value in that room AC category. So our consumer durable play is through a player who is in a reasonably penetrated categories like fans, lighting, and stuff like that. And even they are kind of expanding into kitchen appliances and raising distribution in that segment. But generally, when we invest in a company, we look at a slightly longer term and we look at their steady state earnings potential and we evaluate based on that. So 1 or 2 quarters of negative earnings is not a hindrance for us. But having said that, so the company which we are invested in, they are not into room AC category, and those segments still haven't got attractive to us from a valuation perspective.
Okay, and just the last one, George, a quick take in terms of overall that you're looking at from the infra side. Did you jump into the defense rally that you saw recent time as well? Is that something of your interest?
See, some of the order books have gone multi-fold in some of those defense companies. But the point to note is, there are execution risks which can play out in some of these firms, and which we have seen even historically, and there are risks that these companies may not make the kind of target margins which investors are expecting. So given where the valuations are and some of the execution risks that could play out, so we have stayed away from some of these popular defense themes.
Okay, George, thank you so much for joining in with us this morning on CNBC TV18, giving us your view on the market as well as individual sectors.